Imagine a company right at the forefront of personalized medicine, literally unlocking the human genome. Sounds amazing, right?
Absolutely cutting edge.
But what if that same company is sailing straight into, well, a perfect storm? Massive challenges, geopolitics, intense competition.
Yeah, it's a complex picture.
That's Illumina for you, ticker ILMN. Welcome to the deep dive. This is tailored just for you, digging into the investment analysis sources you sent over on Illumina.
Our job is basically to sift through it all, pull out the key takeaways for you, quickly.
Exactly. And hey, before we dive in, please like and subscribe to Stock Analytics AI. Don't forget, for just Euro 4.99 a month, members can give us a ticker, maybe like ILMN, and get a prioritized deep dive like this one focused on analysis or maybe earnings.
It's a great way to get focused insights.
So today we're unpacking Illumina, the business, the leadership, financials, the big risks, the opportunities too. And we're leading up to this question. Stocks have been a beating lately, right?
Oh yeah, significantly.
So is the market being overly harsh? Or is this price actually about right? Stick around.
We'll explore that.
We're using May 25, 2025 as our reference point, looking at ILMN on the NASDAQ, all based on the sources you provided. Okay, let's start with the basics. What does Illumina actually do?
Right. So Illumina is essentially the global leader in tools for genetic and genomic analysis. Their mission statement is pretty ambitious: improving human health by unlocking the power of the genome.
Oh, okay.
They serve research labs, clinical settings, and various applied markets. Think of them as providing the fundamental kit, the gear, for reading DNA.
And what does that gear look like? What are the main products? How do they make their money?
Good question. They have these big sequencing instruments, the NovaSeq X for high volume, NextSeq, the smaller MeSeq. They also do microarray kits, another way to look at genetic variations. But the real key is their business model. It's often called the razor and blade model.
Ah, like printers and ink.
Exactly like that. They sell the instruments, the razors, which can be a big upfront cost. But the consistent profitable revenue comes from the blades and the consumables. These are the special regions, flow cells, kits. You need them every single time you run a sequence on their machines. The sources said consumables were over 60% of revenue in Q4 2024.
Wow, okay. That sounds like a really solid base for the business.
It absolutely is. And their newest big machine, the NovaSeq X Plus, is pushing the cost of sequencing a human genome down towards $200.
$200? That's incredible.
It is. It makes genomics much more accessible, which should grow the whole market. But they're not just hardware and consumables. They're building out their software side, too.
The informatics, right.
Precisely. Tools like Dragon for analysis, Base for cloud management, systems to handle all that data. They're building an ecosystem.
Makes sense. You need help managing all that information.
And they're moving into what's called multi-omics, looking beyond just DNA. They're planning a spatial transcriptomics platform for 2026, proteomics maybe H1 2025. The goal is to integrate different data for a fuller biological picture.
Okay, interesting. So expanding beyond their core sequencing, what about the overall market? Is genomics growing fast?
Oh, incredibly fast. The sources show really strong growth forecasts, like high double-digit KGRs out to 2034.
For example?
Genome sequencing projected at over 16% CAGR, personalized genomics over 17%, and NGS, their core tech, over 21% TAGR.
Those are huge numbers. What's driving it?
A few things. Sequencing costs are plummeting, like we just mentioned. Rising rates of diseases like cancer and genetic disorders drive demand. Precision medicine is becoming more common. Tech keeps advancing. Even direct-to-consumer tests play a role.
Right, like 23andMe and others.
Exactly. And within that growth, consumables are the biggest slice, fitting Illumina's model perfectly. Geographically, Asia-Pacific was the fastest growing, but there are some headwinds there now we'll need to talk about.
Okay. And I assume there's a complex regulatory environment.
Definitely. Especially for clinical use. You've got the FDA, CLIA for labs, FTC in the U.S., globally, things like GDPR in Europe for data privacy, HACCP in the U.S., GNI for genetic discrimination.
That sounds expensive to comply with.
It is. The sources mentioned GDPR compliance alone costing around $3.2 million a year. Plus, the rules around genetic tests, like LDTs, are always shifting.
Okay, good context. Let's switch to Chapter 2, management. I heard there was a change at the top recently.
There was. Jacob Thaysen became CEO in September 2023. He replaced Francis D'Souza.
Why the change?
Well, Thaysen was specifically brought in to navigate the company past the whole G-Rail acquisition mess. He comes from life sciences, places like Agilent, with experience driving growth.
Got it. So what's his strategy now? What are the priorities?
The focus seems to be on customer-centric innovation, operational excellence, getting margins growing sustainably, pushing that multi-omics expansion we talked about, and importantly, dealing with those headwinds like tariffs.
And cost cutting.
Yes, they announced a $100 million incremental cost reduction program for fiscal 2025.
And the board saw some changes too, right? Related to shareholder activism.
That's right. After Carl Icahn's proxy fight in 2023, which already led to changes, the board got refreshed again. Scott Gottlieb, former FDA head, became non-executive chair in March 2025.
That's a big name.
It is. And Keith Meister from Corvex Management, an activist fund, also joined the board. Corvex owns about 1%. It definitely signals more focus on governance and shareholder value.
So management has really been in the hot seat since 2023.
Absolutely. The Jerial situation was huge. They closed the deal, despite regulators saying no, leading to legal fights, big financial write-downs, and finally being forced to sell Jerial off in June 2024.
Wow.
And now they're dealing with the U.S. tariffs and the China ban, which we'll get into. That forced them to lower guidance and focus on cost cuts.
It sounds challenging, but the sources mention some insider buying. Does that signal confidence?
It's often seen that way. CEO Thiessen bought nearly $1 million worth of stock, a big jump in his holdings. The CFO bought some too. It suggests leadership believes in the company's prospects, even with the current issues. Doesn't guarantee anything, of course.
Right, but it's a positive signal.
Right.
Okay, Chapter 3, Financial Health. How does all this translate to the numbers?
Well, you see the pressure on the top line. Core Illumina revenue actually dipped slightly in fiscal 24, down 2%, and again in Q1 25, down 1%.
In the outlook.
For the full fiscal year 2025, they're guiding for another 1-3% decline. So that's a shift from their historical growth of over 5% annually over the prior 5 years. The headwinds are definitely biting.
Okay, revenue's pressured. What about profits? Margins?
This is where you have to be careful. The standard GAAP numbers are really messy because of Grail. Huge impairments hit the bottom line.
Right.
To get a clear view of the ongoing business, you need to look at their core non-GAAP figures. On that basis, margins are still quite healthy.
How healthy?
Core non-GAAP gross margin was around 68% in FY24, operating margin over 21%. Q1 25 was similar. And the guidance for FY25 operating margin is still decent, around 21.5, 22.0%.
Okay, so the underlying core business profitability is still there, separate from the Jerial impact. What about earnings per share, EPS?
Core non-GAAP EPS was $4.16 in FY24, to sell of 97 cents in Q1 25. The guidance for FY25 is $4.20, $4.30. But importantly, they lowered that guidance from earlier estimates, mainly because of the tariff impact.
I see. And the sources mentioned some concerns about earnings consistency overall.
Yes, looking at the reported GAAP EPS over 5 years, there was apparently an 8.9% decline cited, reflecting that volatility, including the Jerial effects.
How does the balance sheet look? Cash, debt?
Pretty solid, actually. They had about $1.24 billion in cash in Q1 25. Debt to equity was manageable, around 0.86 at year-end 24.
Yeah.
Liquidity ratios, like the current ratio around 1.77, suggest they have enough working capital.
Okay. And free cash flow. You mentioned the consumables earlier.
That's a real bright spot for the core business. They generated strong free cash flow, about $1.07 billion in FY24, over $200 million in Q1 25. That recurring consumable revenue really drives it.
So that gives them flexibility even with revenue down.
Exactly.
What about return on invested capital, ROIC? That's a key metric.
Yeah, again, the reported GAAP ROIC is negative because of the Grail write-down, so it's not very useful. But the sources did calculate a core non-GAAP ROIC for FY24.
And what was that?
Around 21.9%. Stripping out the Grail noise, that suggests the underlying business generates really good returns on the capital invested in it, much higher than a typical cost of capital.
That 21.9% is impressive for the core operations. Are they still investing heavily in R&D for the future?
Oh yes, very heavily. Over $1 billion a year, which was more than 22% of revenue in 2023. That's higher than the industry average.
And where's that R&D focused?
On the next-gen platforms like NovaSeq X, pushing into multi-omics like we discussed, spatial transcriptomics, proteomics, and boosting their software, informatics, and AI, often with partners. It's essential spending for them.
So summing up the financials, near-term revenue pressure, GAAP numbers messy due to Grail, but the core business seems to generate strong cash flow and good non-GAAP returns. Is that fair?
Yeah, it's a very good summary of what the source analysis indicates. The core engine is still humming despite the external noise.
Okay, let's move to Chapter 4, Market Sentiment. How are investors and analysts viewing this mixed picture?
Sentiment is definitely mixed, maybe leaning cautious. The analyst consensus seems to be a hold, according to MarketBeat and Zacks, although some terms do maintain buy ratings.
What about price targets?
They're all over the place. The range mentioned was $70 to $185 for the next 12 months. That huge spread tells you there's a lot of disagreement and uncertainty out there.
Has that sentiment shifted recently?
Yes, there have been target cuts and downgrades lately. Analysts are citing the China issues, potential NIH funding worries, and just the general competitive heat.
And the stock price itself reflects that caution, right?
Absolutely. Down about 40% year-to-date as of late May 2025, trading around $80, much closer to its 52-week low than its high. The market has definitely reacted to the risks.
Any other indicators? Short interest?
Option.
Yes.
Short interest was noted around 5.5 million shares, about 3.4 days to cover. It had come down a bit, so maybe slightly less bearishness, but still significant. Options activity showed a lot of interest in puts around the $80 strike, suggesting some investors were betting on or hedging against further near-term downside.
All right, Chapter 5. Ownership structure. We mentioned Icon and Corvex. Anything else noteworthy there?
Not a huge amount of detail in the sources, but they reinforce the impact of Icon's previous fight, Corvex now having a board seat with about 1% ownership, UBS AM buying shares recently, and that insider buying by the CEO and CFO we talked about. Shareholder activism has definitely shaped things.
Okay, now for the big one, Chapter 6, risk assessment. Let's really dig into these headwinds, starting with the geopolitical ones, China.
Yeah, this is probably the biggest immediate headache. The U.S.-China trade friction hit them directly. The sources estimated the 2025 U.S. tariffs cost them $85 million directly, hitting EPS by about 34 and 25.
Okay, that's the tariff side. What about the ban?
That's the killer blow, potentially. China put Illumina on its unreliable entity list and banned imports of their sequencers starting March 2025.
So effectively locked out of selling new machines there.
Seems like it. China was about 7% of revenue historically. This ban forced them to slash their FY25 guidance for Greater China way down to maybe $165, $185 million.
And the strategic risk?
It's huge. It opens the door wide for Chinese competitors like BGI Tech to grab that market share, scale up, and potentially become stronger global rivals down the line. The $100 cost cut is a reaction, but this, plus worries about U.S. research funding, may be slowing down. It's described as a double whammy. We need to be clear we're just reporting the business impacts stated in the sources, not taking any political view.
Understood. Neutral reporting on the impacts. What about competition beyond China? Is that heating up too?
Definitely. The market's growing, but attracting more players. You've got big diversified companies like Thermo Fisher. You have specialists in long-read sequencing like PacBio and Oxford Nanopore. Their tech handles certain things Illumina's short-read tech struggles with.
Right.
Then there are aggressive pricers like BGI Tech globally, not just in China. And newer entrants like Ultimate Genomics pushing for ultra-low-cost sequencing.
And isn't Illumina competing with itself a bit with the new NovaSeq X?
That's the innovator's dilemma part. The NovaSeq X dramatically lowers the cost per genome, which is great for expanding the market, but it also lowers the price Illumina gets per unit of data.
So they need much higher volume.
Exactly. They need way more sequencing volume or customers adopting those newer data-heavy applications like multiomics to make up for the lower price per run. Otherwise, margins could suffer. Plus, there's always the risk some totally new disruptive tech comes along.
Okay, what other major risks did the sources flag?
Regulatory and reimbursement are always big, especially for clinical. Getting FDA approvals is tough. The rules around LDTs are changing. Data privacy compliance costs money, like that $3.02 source for GDPR. And getting insurers to pay for tests is key.
Dependence on research funding.
Yes, about 85% of revenue tied to research clinical budgets.
Okay.
So potential government funding cuts, like NIH worries, make them vulnerable. IP is another one. They have lots of patents, but disputes happen.
Any internal or operational risks?
Some weakness mentioned in instrument sales recently. High R&D spend needs growth to pay off. Their core tech has limitations, like errors or handling long DNA fragments. And just managing the sheer volume of data is a challenge.
Okay, that's a lot of risk. The sources had a SWOT summary. Can you hit the highlights? Strengths, weaknesses, opportunities, threats.
Sure. Strengths. Global leader, brand, IP, high switching costs, huge installed base, informatics, multiomics push.
Yeah.
Weaknesses. High pricing historically, funding dependence, instrument weakness, R&D costs, tech limits, the Grail hangover.
Okay, opportunities.
Clinical markets, oncology and IPT, rare diseases are huge.
Yeah.
Multiomics growth, emerging markets outside China, AI integration, agrogenomics.
And threats.
China tariffs ban, competition, disruption, regulations, funding cuts, cybersecurity, IP fights. It really maps out that complex picture we've been discussing.
Right. So despite all those threats and weaknesses, the sources also see significant growth opportunities.
Yeah.
Let's pivot to those. Where's the upside potential?
A lot rests on expanding into clinical applications. Oncology testing alone is projected as a huge market, over $12 billion by 2027. Reproductive health, like NIPT, is already big. Rare diseases, over $8 billion by 2026. And even things like liquid biopsy for early cancer detection, Illumina is a key tech supplier there.
And the multi-omics strategy.
That's critical. Moving into spatial transcriptomics in 2026, proteomics in 2025, it's about offering a more complete biological picture, integrating data. This could lock customers in deeper and justify higher value, higher margin solutions, moving up the value chain.
Makes sense. What about geographic growth outside the US and China?
Yeah, despite the China issue, other emerging markets look promising. Asia-Pacific, excluding China, still forecasts for strong growth, same for Middle East and Africa. Lowering sequencing costs with NoSec-X is key to unlocking these potentially more price-sensitive markets.
And AI, with all this data.
Massive potential. AI in genomics is forecast to grow incredibly fast, like 35% CAGR. Illumina's integrating AI, partnering with NVIDIA, Google, IBM Watson. It's about helping customers make sense of the data deluge, adding value beyond just the raw sequence.
Even agriculture was mentioned.
Yep, agricultural genomics, smaller than human health, but still a multi-billion-dollar market, growing at nearly 10% CAGR. Another application for their core tech.
So the growth plan seems to be make basic sequencing cheaper to grow the pie overall, while simultaneously adding these higher value multi-omics and informatics layers to capture more value per customer.
That's the tightrope they're walking, essentially. Broaden the base, deepen the value.
Okay, let's wrap this up. Chapter 7, conclusion. How do the sources pull all this together for an investment perspective?
Well, the analysis clearly acknowledges Illumina's core strength. They are the leader, great brand, sticky customers due to the installed base, that fantastic free cash flow from consumables, and that healthy calculated core ROIC. But those strengths are currently fighting against some really significant, very immediate headwinds. The China ban and tariffs are real and hurting now. Competition is fierce and coming from everywhere, and there's just a lot of execution risk. Can they navigate all this successfully?
So balancing those strengths and very real risks, what's the final investment conclusion from the source material?
Based only on the analysis provided in those sources, the recommendation for Illumina, ticker ILMN, as of May 25, 2025, at that $80.35 price, is a hold rating.
A hold, not a buy, even with the stock down so much and those long-term growth projections.
The reasoning given is that while the long-term genomic story and Illumina's core business strength are attractive, the level of current uncertainty is just too high right now. The China situation, the competitive onslaught, the sources suggest you'd need a bigger margin of safety, a lower price perhaps, to compensate for those risks before calling it a buy.
Which brings us right back to our hook question. The stock's down 40% year-to-date, near its lows. Is the market maybe being too negative here? Is it possible the market is overlooking the resilience of that core business, the cash flow, the non-GAAP ROIC because of the noise?
That is precisely the core tension highlighted. The market has priced in a lot of bad news. And that gap between the messy GAAP numbers and the healthier core non-GAAP numbers could suggest undervaluation of the ongoing business. If, and it's a big if, they can successfully execute their way through these current storms.
So if you're watching Illumina closely, what's the single most important signal to monitor, according to this analysis? What's the biggest swing factor?
The sources point to a few key things. Definitely execution on multi-omics. Can they deliver on that strategy? Any news out of China, good or bad, will be critical. And maybe most importantly, how effectively can they defend their market share against competitors attacking on price and technology? Which of those ultimately moves the needle the most for Illumina's future? That's the multi-billion-dollar question for investors.
Really fascinating. A company truly at a crossroads.
For sure. A leader facing major tests, but with undeniable long-term potential if they navigate them well.
Subscribe to Stock Analytics AI on YouTube.
Research and AI disclaimer. This report is for informational and analytical purposes only and does not constitute investment advice or a recommendation to buy, sell, or hold any security. The information contained herein has been compiled from sources believed to be reliable and is current as of May 25, 2025. But its accuracy and completeness are not guaranteed. All financial figures and metrics are based on publicly available information and company disclosures as of this date. Investing in equities involves risk, including the possible loss of principal. Past performance is not indicative of future results. The author of this report is a senior financial analyst with expertise in value investing and equity research. However, Readers should conduct their own due diligence and consult with a qualified financial advisor before making any investment decisions. The views expressed in this report are subject to change without notice. The analysis of the potential effects of the U.S. imposed tariffs of 2025 is based on currently available information and involves assumptions that may not materialize. Geopolitical and economic factors can change rapidly, significantly altering the business environment for companies like Illumina, Inc. Forward-looking statements disclaimer. This report contains forward-looking statements, including projections, estimates, and forecasts regarding Illumina, Inc.'s future financial performance, market position, and strategic initiatives. These statements are based on current expectations and assumptions that are subject to risks and uncertainties. Actual results may differ materially from those expressed or implied in such statements due to various factors, including but not limited to those discussed in the Key Risks and Challenges section of this report and in Illumina, Inc.'s public filings with the Securities and Exchange Commission. There is no assurance that any of an